All right, guys. Hopefully everyone had a great weekend. Interesting week last week, obviously, with the volatility. Hopefully you didn't get hurt too bad on the pullback. I know a lot of people were hurting, but that's why you got to manage your risk, right? So make sure that if you're trading options, guys, on short durations, don't risk too much. I always say no more than 1% if you're doing short-term contracts, because they can go to zero very, very fast, as a lot of people saw last week. So starting off today with Apple, because Apple had a nice pullback last week. On Friday, it pulled down to 117.57. And I think we're getting near a good area of buying. Again, we broke below that 120 area, but we closed above it as well on Friday. So there is potential for us to pull back down to around the 110 area. That's where I'm interested in going along. But I also wouldn't be shy about starting a position here longer term. As long as you're going into leaps, for example, if you're going out to January 2022, that would be appropriate because you'd have enough time for recovery, even if it pulled down to the 110 area. But again, I always mention to people to stagger your buys, right? So for example, let's say that you want to allocate 5% of your portfolio to Apple, right? Well, why not allocate like 2% right now? And then if it pulls back to 110, for example, allocate an additional 2%. And if it pulls back to 100, allocate an additional 1%, right? This way your average price will be around somewhere around like 113, 114 or so, instead of buying all at 120, at which point if it pulls back to 110, you can't average down anymore, right? Staggering your orders and buying at different prices is one of the better ways to manage your risk, because buying all at once at one price isn't usually prudent, right? It's hard to catch the bottom, but if you manage to stagger your buys, you can have an average price that's on the lower end versus buying at a higher price and then watching it go down, being unable to actually benefit off of that further dip, and then watching it recover again later on, right? So let's look at some ideas on how to trade Apple for the coming months. Again, I mentioned that I want to go longer term on it, not shorter term, because given the period of heightened volatility, we could see a further pullback down to the 110 area, maybe even down to 100 possibly, right? At 100, I think you're pretty safe on a long-term buy there, easy, right? So looking ahead 2 weeks out, the expected move on Apple is roughly about $7 in one direction. So upside of 128, downside of 114 or so. But I'm looking at leaps, right? So January 2022. And if you're going to do this, the idea here is that instead of buying the stock itself, you want to buy call options that are deep in the money, because that simulates buying the stock itself, right? So for example, to buy 100 shares right now costs you about $12,000, right? Alternatively, you could buy one call option with 100 strike price, and you're paying about $28 of premium there, right? So your break even is 100 plus 28, it's 128. So you're paying about $650 of extrinsic value on the contract, given that the current price of the stock is 121.50 or so. But what you can then do if you're trading in a margin account is you can sell contracts against that. So for example, if you wanted to sell the April 16th above your break-even price, keep in mind your break-even is 128, right? So if, for example, you want to sell the 135 contract for about a month out on April 16th, you can pull in about $1.40 here, right? That reduces your break-even cost from 128 down to 126.60, right? Which isn't too bad overall. And keep in mind, you can do this again for May, June, July, so on and so forth until expiration, right? So you can pull in some premium while you're waiting for the stock to recover. If by chance it pushes above 135 come April 16th, well, what's going to happen, right? Your leap contract, the call option for January 2022, that will be worth over $35 because it's deep in the money, right? Your short contract will be obviously expiring the money as well, at which point you can either buy it back for a loss or perhaps a small gain or break even. And basically you can either hold your long-term position, the leaps if you wanted to, or you can close it out and realize your profit. In that case, you make a profit of about $8.40, right? On risk of 26.60, right? So not too bad in that regard over there. Alternatively, if you wanted to trade it shorter term, you could look at perhaps June or July. But again, it's hard to define how far we're going to drop broad market and how fast we'll recover. Over the past, I would say 10 years or so, everyone expects the market to be bought up, again, by the dip, and we usually have fast recoveries. But there may come a time when that isn't the case, where we trade sideways for a few months, or maybe down, flat or down, right? That is possible as well, and people aren't really accustomed to that kind of market, because since basically 2009, we've seen a very, very sharp bull market. And if we're trading sideways for a while, then obviously you won't want to be trading shorter term contracts. That's why trading the leaps is a much safer play to take, right? Alternatively, if you want to be bullish, again, I'm not advocating doing this, but if you want to be bullish shorter term, I'd maybe go out to May or June, buy some time. Don't trade shorter term. Don't trade March. Don't trade April. That's too short term, right? Keep in mind, earnings will be sometime, I think, in May, I believe, because they're reported in February, right? So looking at February, March, April. So yeah, it'll be May timeframe. So over here, you're probably going to see elevated premiums, and you may want to trade perhaps some spreads. Again, the IV isn't very high right now in Apple. It's actually lower than the historical, so it's not too bad. But yeah, trade cautiously. I think Apple and a few other names, namely the Fangman stocks, have been doing pretty well overall, fundamentally speaking, but the prices have not reflected that at all, right? Like Apple, AMD, Microsoft, Amazon, the list goes on. They all did great on their earning reports, but they did not see a appreciation in their stock price, right? An appreciation in their stock price. So Apple was at 145 prior to earnings. They've since then fallen down. Where's my chart again? My chart just got lost. And so here it is. So you can see they've since then fallen from that high down to over here. They're down about 19% almost in the last month or so, right? So oftentimes, I mean, you don't often get discounts on Apple. Whenever you get a discount on a company like Apple, you buy it longer term, and you don't try and trade it for those pennies, right? You're buying it longer term. So that's Apple right there. Next up, we're gonna look at AMD, which I think is also a great opportunity here too. I've been mentioning the past few weeks that 85 was support, and the second level of support was 75. Third level is 60, right? So on Friday, we actually tagged that 75 area. We hit a low of 74.20 and recovered up to 79 almost, but doesn't mean we're out of the woods yet, right? I again think that AMD is a great long-term investment, and trading it longer term is better, or holding it longer term is better than trading it, right? Because if, for example, let's say I tell you that in a year's time, AMD is at 120 a share, and maybe you traded it here from 75 to 85 and made perhaps $5 per contract or something like that profit, right? That's fine and dandy, but would you not prefer to take a longer term approach and make more money longer term than trading shorter term, right? And making less money? It's less stress and less risk because you're buying more time, right? So I mentioned in voice chat during the week, last week on Friday, I mentioned to everyone, look at AMD at 75 area, and that's an area to look at, maybe going long and starting a position. Again, staggering your orders, right? So maybe starting a position at 75, and then if it falls to 70, buy some more, 65, buy some more, 60, buy some more, at which point your average price will be somewhere right around here, right? 67.50, right? That's the way you want to trade to get into a position. But looking at the options chain on AMD, we can see that the expected move for a couple of weeks out right now is approximately $6 in one direction. So upside of 85, downside of 73 or so. IV is a little bit below the historical right now. But I mentioned that a decent idea to trade AMD would be also leaps, right? Again, if you want to buy 100 shares of AMD right now, it'll cost you about $8,000 per 100 shares. Alternatively, you could buy one call option on Friday. I mentioned it was at $20 per contract. These contracts, a 60 strike over here, deep in the money. So you're paying $2,000 instead of almost $8,000 per contract, so a quarter of the risk. And you have basically, you would have paid at that point in time extrinsic value of about $4 or so per share or per contract, right? Now it's almost at your break-even price of 80. But again, if AMD trades at, let's say, 100 or 110 or 120 by January next year, this is going to look like a pretty great deal to buy contracts at around $20 each, right? A much more conservative approach. And the nice kicker here is that look at the price of the at the money calls right now, right? 80 strike at the money calls, $13. This means that if AMD were to pull back down to $60 a share, right, pretty rapidly, which could happen, these contracts would trade at around $13 as well, probably even higher than that because the IV would elevate too, right? So in seeing that, you have a much better margin of safety on the contracts here because you're buying longer term, and they have the potential to also elevate in price due to the Vega expanding on the IV expansion as well, right? So that's a much better way to play AMD than buying the shares themselves. They don't pay a dividend, so there's no advantage to holding the shares over the leaps instead, right? So you could buy, for example, the 60 strike call option. Again, now it's trading at around 23, $24 per contract, but it was trading at a low $20 on Friday. And if you wanted to sell, again, shorter term contracts against it, keep in mind your break even now, if you bought it right now, is around 24 plus 60, 84. So you sell above 84. You sell, let's say, for example, the 90 strike contract for April 16th, you're getting about $1.30 there, right? So you're reducing your risk from, let's say, 24 down to 22.70, right? Break even's 82.70. If it goes to $90 by April 16th, you're making yourself $7.30 per contract, right? Not too shabby. And then you can do that all year long and sell more contracts. Or alternatively, let's say that April had expired near $90, and then you want to turn your long-term position into a spread, do that as well, and sell the at-the-money contract when it's at $90 or so. And if you do that, then basically you're going to have a nice 30-wide spread on AMD at a cost of around $7 to $8 per contract, right? So you're risking 8 to make about 22. Your break even would be around 68, and obviously max profit would be above 90, right? So that would be a not so bad way of playing AMD longer term. Again, I think that it is undervalued right now because if you look at the metrics versus NVIDIA, so currently, just some numbers for you guys, market cap on AMD, $93.5 billion. That's how much they're actually worth as a company, right? Their current net income or profit is $2.5 billion. Current sales or revenue is almost $10 billion, right? So the current price to sales ratio is 9.58, right? Current price to earnings ratio is 38. NVIDIA is worth $307 billion. So again, contrast that, right? NVIDIA is worth $370 billion. AMD's worth $93 billion. So AMD's worth less than a third of the value of NVIDIA. AMD's net income, $2.5 billion. NVIDIA's net income, $4.3 billion. So just more than half the net income of NVIDIA for AMD. Sales for NVIDIA, $16.68 billion versus AMD at $9.76 billion. So either AMD is very undervalued here or NVIDIA is very overvalued here, right? I would say that AMD is undervalued versus saying NVIDIA is overvalued. And consequently, I think that AMD is going to do very, very well over the next 1 year, but more importantly, over the next few years, right? So if you want to go longer term, 2, 5, 10 years, not a bad idea at all, right? Just for reference, over the past couple of years, NVIDIA grew their revenues from 6.7 billion in 2019 to over the last 1 year period, they've made 9.76 billion. So they're up almost 50% year over year revenue wise, which is pretty incredible for a large company, right? They're growing very, very fast right now. That's AMD. Next up, we're going to discuss, one sec, we're going to discuss Alibaba. So Alibaba was one of the worst performers of the mega cap stocks in the overall broad market. They were down, I believe it was around 11.2% from their highs. I'll put the chart right now so you can see it. So here's the chart on Alibaba. So their highs were reached at 320 back in October last year. They've since fallen now from the current price about 28%, but more recently they're down about 17%, right? From their recent highs back in early February, right? So looking at the chart over here, I would say that Alibaba has potential to drop down to 210 area, but again, it would be a pretty strong buy given that we saw strong support here back on December 24th, right? See that big volume candle right there, 100 million shares plus. that was a huge, heavy buying right over here in this area. And consequently, that means heavy support. And also, if you notice over here, support is all the way across this area right here, right? So heavy support at 210 area. But buying leaps on Bubba is more expensive. So, I wouldn't advocate doing that. Shares are not a bad option, but again, expensive for most people. If you do want to trade it, call spreads may be a nice way to trade the upside. Again, I'd wait to see what happens in the broad market over the next couple of weeks. If it tags 220 area, I'd start going long perhaps over there, and then use call spreads, because if it falls down, you're going to see IV elevated as well, right? So let me just pull up the option chain. One sec. Here's Bubba. So for the next 2 weeks or so, expected move on Bubba is around $14 in one direction. So upside of 249, downside of 221, right? Longer term trading it, I would say going out at least, again, not April. April's too soon. It's only about 40 days away. At least May or maybe even June, right? I would say June would be safe. So if you went out to June and did some spreads, you could perhaps do a 240, 270 call spread. That's 30 wide. You're risking about $9 overall. Break even's 249. Maximum profit's over 270. Maximum profit overall is 30 spread wide minus $9, $21. Right. So you have about 2.33 reward per unit of risk. Right. Not too bad at all. Next up, we have Crsr. So Crsr also pulled back a lot last week too. They had a great report a few weeks ago. They have lockup expiring. I believe it's March 22nd. Don't quote me on that, but check it out for yourself if you are trading it. So keep an eye on that date, which is in a couple of weeks, and wait to see if it falls further on lockup expiration. But again, you can see over here that there's some support at around 2750 from before it popped off, right? It was trading in a pretty sharp range between 33 area up to a high of about 50 for the past few months. And given these nice wicks over here, it's possible that we see a reversal back up to the 40 area in the next few months, right? But there's an issue with trading Crsr in that they only offer monthly OPEX contracts, and the liquidity is not always there because the volume is lower and the open interest is lower for certain strikes, right? So, I would say probably cash secured puts are not a bad idea if you want to own the stock at a lower price. Let's look at that for a sec. So again, March is pretty soon. Looking at April 16th, you can sell the 25 strike put options for about 90 cents. Effective ownership price is 25 less 90 is 24.10, right? That's not too shabby at all. If you go out to May, you can get even more premium perhaps again as well, but then you might miss the reversal back up to like 40 plus on the stock, right? Again, I would wait till the lockup expiration before doing anything at all. So wait till March 22nd, I believe it is. And after that, you can look at doing, March 22nd, that'd be the Monday after monthly OPEX. So yeah, so I would wait till after that date to see what happens with the stock price before making a decision on that. But obviously, do your own research. I'm just putting out some ideas here for you guys to think about, right? Everything here is for educational purposes only. Do your own research, do your own due diligence, and manage your own risk accordingly as well. Next up, a big name that everyone talks about all the time, myself included, Palantir. Right, so Palantir fell on Friday down to, let me put the chart on it, one sec. Down to, where is it, 3 months. So here's Palantir's chart over here, right, you can see. It fell down to a low of 20 on Friday, right? Big fat wick, and it closed actually flat week over week. If you pull up the 3-month chart and go to the weekly, you can see it closed last week at 23.90. This week 23.95. So that's pretty good relative strength versus the broad tech market, given that the market fell pretty drastically this week, right? It's possible we saw the bottom on Friday at $20. I'm not sure we're going to get a buying opportunity below 20 again. But that being said, with the IV elevating it again now, I would look at perhaps doing covered strangles if you do own the stock, right? So let's say, for example, you own the stock and you want to sell some covered calls on it, right? First of all, wait till the IV elevates. Don't sell covered calls when the stock price is low. A lot of people make the mistake of thinking that, oh, you know what? I want to pull in premium all the time, so I'm going to sell covered calls all the time. No. You want to sell covered calls when the stock is on an upswing, because if you do it when it's on a downswing, you're going to get the least amount of premium. And then when it swings back up again, you're going to get called away and miss out on some nice gains, right? So you want to wait for a recovery in the stock price first before you sell premium against it, because again, this stock can move fast. We've seen it move very fast. We saw it move from 25. Let me put the chart again just to show you guys, right? We saw it move from 25 up to, where was it? 25.30 on January 21st. It hit a high of 45 on the 27th. So it has the ability to move very, very rapidly, right? Again, we saw it move from 31 on February 4th to a high of 39 on the 8th, right? So you can see these drastic moves, and consequently, you want to wait for a nice move on the upswing if you're holding stock to sell covered calls on it, right? So looking at the option chain here, right? Expected move for the next couple of weeks is about $4 in one direction. So upside 28, downside of 16 or so. Sorry, I mean 20, right? Which we saw on Friday. So looking ahead a couple of weeks, again, I wouldn't trade it shorter term. I would trade at least 3 months out. So May OPEX is pretty nice, and call spreads, if you're going to go long options, aren't a bad idea. So for example, the 30-40 call spread right now is trading at about $1.20 or so, right? So you're risking $1.20 to make $8.80, break even is $31.20, and you have 2.5 months till expiration. That's not too bad at all, right? Great asymmetry of risk, realistic price target as well, and the max profit is within reach as well, right? 3 months or 2.5 months from now. Alternatively, as I mentioned before, if you hold the stock itself right now and want to sell covered calls on it, wait for a pop up first, right? And then perhaps sell. I would sell the 0.2 deltas. So in this case, the 35 strike right around here. If you sell that, plus you sell cash secured puts to try and buy the stock at a cheap price. Again, let's say you want to own it at $20 and you don't mind owning it there. You'd sell the 20 strike puts over here for $1.25 or so, right? So selling the cash secured put plus the covered call on stock that you own, you're pulling in a combined premium of about $215 over the course of a month, right? That's about 10% of the stock price in 1 month, right? Even if it pulls back down to $20 a share by April 16th, you're still pulling in $2.15. So your actual break even on the trade is at $17.85, right? Would you mind owning it there? If you don't mind owning it there, then not a bad trade overall, right? And again, you can do this over month over month. And if it trades flat for a few months in a row, because this is a long-term stock, again, keep that in mind. It's a 2 to 5 year play. I would say maybe even longer than that. I believe in it very long-term, and I think that it's going to be a great performer for people's retirement accounts, right? So think about it with a long view, not a short view. Again, if you want to trade a short-term, I'll go at least a few months out, use call spreads, and just manage your risk in those positions and take your profits there, put them into stock, hold longer term, right? Obviously, again, do your own research, do your own DD, manage your own risk, right? Next up, we're looking at Qqq ETF. So that had a nice big pull last week on Friday, and then it recovered drastically as well. So here's the chart we can see. Here is the chart. Where is it? So we can see that since February 16th, we've already fallen at the low on Friday. We're down 12.1%. And I'd mentioned just in chat that over the past year or so, we've seen numerous pullbacks that have been bought up. So you can see over here down 14%. Over here we were down about 11%. Over here we were down like 6% over in a couple of days. Over here we were down 7%. Right. So in bull markets, it's perfectly healthy to have pullbacks. Right. People get all bent out of shape because they're over leveraged. They're buying short-term options and they're losing money very fast. Right. I know people that lost everything that they made in the last 4 or 5 months in the last 2-3 weeks, all because they were not managing their risk. They were buying call options that expired in a couple of weeks out. And that's not how you make money longer term, right? That's gambling. That's not trade. That's not investing. That's gambling, right? So you need to differentiate between if you want to be a gambler or if you want to be an investor, right? If you want to be a gambler, chances are you won't live very long to keep doing it. If you want to invest prudently, it's not as exciting, but it works, right? So looking at Qqq, we saw a massive wick to the downside. It hit a low of 297.45 on Friday and then recovered to 309. That was a massive recovery. I think we're down at 1.3%. and we ended up finishing the day up 1.6%. So pretty nice recovery overall on the day. But again, keep an eye on this because I don't think we're out of the woods yet. I think we might see some more downside, possibly down to a low of 280 area, which would mean that we'd be down about an additional, I guess, let me pull this line out one sec. Pull down to as low as this area right here. So we'd be down about 17.6% overall. That would be a really nice pullback. And that would mean, Apple would probably be at around 110-ish or 105-ish. Amazon probably around 2,700 or 2,600. And you're going to see some good deals to be had right there. Again, invest in companies that are always making money, even in the worst economic climate we've ever seen globally, right? Since the Great Depression. Amazon, Microsoft, AMD, NVIDIA, what else? Apple, obviously, Salesforce, they're all doing very well right now. Stock price is not indicative at all of performance. Tesla is a case in point, which we're going to discuss in a sec. So I won't elaborate further on triple Qs because it's an ETF. I mean, obviously, if you want to trade it yourself, you can trade it. There are numerous ways to trade it: call spreads, put spreads, whatever you fancy. I would just manage your risk because IV is very high on Qs right now. So keep an eye on that too. But looking at one name that I'm looking at over the past few weeks, and I'm liking a lot, is Sdgr, Schrodinger Technologies. And so this company, they do computation to help biopharma companies develop drugs, right? So kind of like a little bit like Palantir, kind of similar to Palantir, but for the biopharma space, right? So interesting company overall. I believe Bill Gates is investing in it as well. And they had a nice pullback on earnings last week. They pulled down to a low of 63 or so. Unfortunately, option chain isn't very liquid, so you can't really do much there. I'm just keeping an eye on this overall. I haven't invested in it yet myself. I'm just watching it and seeing how it moves. I may take an investment at some point in time, but just making you guys aware of this to look at, right? Sdgr. Next up, looking at, let me close this first. Looking at SPY, right? So SPY. So SPY had a pretty bloody week last week too, but it recovered a lot on Friday as well. So where's my chart? Here it is. Come on. All right, so here's the chart on SPY. And I've been mentioning the past few weeks that we're overdue for a nice pullback, as we hadn't had one since October. And I mentioned that a few weeks ago when we were at 392 or so. So now we're at 384, but we tagged a low point of around 370, 188 on Thursday. It is possible to see more downside though in the market because from top to bottom, we're only down about 5.2%. I expect us to drop down somewhere around this area right here, 355 on SPY over the next few weeks. Again, I wouldn't really play it downside wise. I wouldn't be buying puts on it, for example, but I'm just thinking about it from the perception of, or perspective of where I want to be buying more positions, right? So again, buy incrementally. Like for example, if you want to buy AMD, you don't buy all at once at 75. You might buy a quarter position there, a quarter position at 70, a quarter at 65, and a quarter at 60, for example, right? This way, your average price is somewhere between the bottom and where you initially got in. It's not 20% above the bottom, for example, right? That's a much better way to get more effective prices or better prices. And again, if you buy a quarter position in AMD, for example, at 75 and it bounces to 85 or 90, you're still happy because you still made money, right? You didn't miss out at all. Sure, you didn't get your whole position, but you also didn't miss out overall, right? So SPY, again, keep an eye on this longer term. Qs are getting beat up pretty hard. But SPY, I think, has potential down to 360, 350 area still. And I'm going to be watching that over the next few weeks and buying opportunistically in names I mentioned previously, right? The last name I'm going to discuss today is Tesla because I think the lipstick is kind of coming off the pig right now, so to speak. And we're seeing it get beat up pretty hard. It's now down from its all-time high. Hit a low on Friday, down 40% in the last month or so. Closed at about minus 34% or so. But again, their price got way ahead of performance, right? And you have support now at around 400 now, right? So you still have downside of about $200 per share. People that are buying or that bought in the 800s, you may be bag holding for a long time. I'm not saying to sell your shares, obviously, because if you believe in the company longer term, that's fine. But again, competition is heating up like crazy. Production issues are occurring due to a shortage of chips right now, and you may see a lot of issues with the company going forward, right, because of these issues. So valuation is still absurd. I think fair value is somewhere around like 100, $200 a share, but that's my own opinion, obviously. But if you're long it right now, just be careful because it has potential down to 400 and past that down to around 273 area, right? So if the market sells off further, you're going to see it down at those levels. Okay. We'll stop right here, I guess, and we'll do some Q&A. I'm going to end the video here, obviously, the recording here. If you have any questions or comments, please put them below. Like it, subscribe if you want to share it with a friend or whatever. That's great. Appreciate it. Otherwise, have a great week, and we'll do some Q&A right now, guys.